Now, what I wanted to share again um, with you guys is maybe more of my top 10 in my particular portfolio. And what you'll see is that it's a pretty large position um, overall. And I would say, let me just do some quick math here. Uh, okay. It's about 50 to 75% of my portfolio, we'll say. So I won't give exact numbers because I don't like to share a lot of that stuff. But what I will do is be kind enough to share with you guys my top 10. I'll share with you guys my next stream the the income that I get because it should be on the order of $100,000 if I full port Tesla or TSLY. But what I want to share with you guys, let me exit out and organize some of this stuff here, is the top 10 positions I have in my portfolio. And hopefully this will help you guys because I think some of you guys think that all I do is invest in, um, Palantir. And then some of you guys think all I do is invest in other stuff, um, like dividend stocks and stuff like that. So I have a wider range of different positions. So just on here, I have the stock, the ticker, the name. This isn't real. So let me just erase this. Unidoc Health Corp. The price of the stock, how many shares I have, market value, approximate annual dividend payout, and dividend percentage. Now, the only one that I don't really share everything with is UDOC, which is an undisclosed oil company that I work for. But you can run some approximations and maybe figure out if you really care. I just try to dissociate with my YouTube channel and the company I work for just for, you know, HR reasons. So let me just double check that I'm sharing everything on the screen and we can kind of talk through a little bit about it. And hopefully we can get to after that some Q&A associated with um, the portfolio. And hopefully this is insightful for you guys. So SPY, I don't have all this in my individual brokerage account, but what I did is I combined my individual brokerage account and my 401k holdings. And so you can kind of understand a pretty good part of my portfolio, about 300 grand or so, is in a SPY or SPY equivalent. And so with that, I'm really hoping to get to, specifically in my individual brokerage account, $1,000 a quarter. Now I'm not there, probably close to 600 a quarter in my individual brokerage account. But if you were to include what I have in my 401k coupled with what I have in my individual brokerage account, you get about 4,300, 4,400 a year in dividend income, which I'm pretty excited about that because to me, this is something that's just going to continue to snowball. And I like the S&P, and I think it's a very well managed index fund, just based on the fact of the rules that's been set up with it to make sure that everything's kind of always prospering. And even in down times, you're focusing on the companies that are mostly prospering and not getting hurt here. So the equivalent shares of this is 674 SPY. But like I said, not all this is actually SPY. Some of it is 401k sort of mutual funds that the company has set up. Then you have UDOC. That's my number 2 position ever since Palantir kind of dropped back below, say 1950 or something like that. And so I just have this position in here just based off of share-based compensation that I get and some rewards that I've gotten over the past several years. And so hopefully that'll vest. Majority of it will vest in 2025, and I'll probably keep some of it, but maybe invest some of that into some of these other positions here. Now, not all these are in 100% order because sometimes I have multiple positions in different accounts. And so like this TQQQ in here, this is kind of like a FIT sort of like 5%, 4%, whatever percentage it is. Like if it ends up performing as well as it has over the past 10 years sort of thing, then I will continue to succeed and the portfolio will do extremely well. If it doesn't and it goes to zero, it's what, 64 grand or whatever. So that's a lot of money. But at the end of the day, it's really not going to hurt too much. And so that that'll be that. I mean, it'll be one of those things where it's like it kind of sucks, but I it's not going to really make or break me, right? Then you have at number three, kind of the Palantir, or I guess this is technically number four, Palantir. And this one, goes back and forth between number two, number four, because of the volatility of it. But it's about $60,000 worth at the moment. I would want to potentially look at investing more, maybe getting it to 5,000 shares over the next, say, year or so. But I think a lot of that depends on what comes out of Q3 and the client growth associated with it. I've been rather disappointed with the growth rate coming from Palantir, and I try to think big picture. Like there was a lot of, I think, money coming in, or potential money and revenue coming in from the CDC deals and the vaccine rollouts and stuff like that. And I anticipate there was some money associated with it. I assume maybe it was done for free, but I think associated with that, if that was true and there was money associated with that, is kind of on the decline. And so, with that large piece of revenue coming off the decline, you're offsetting that as you try to get more and more clients, right? So it's going to be a huge big hole in your revenue book that you have to kind of keep in line. But anyway, then moving on to Shell. So I'm big in the oil and gas industry, as you guys know, and I like Shell a good bit. They have I work with them quite often, and I think that they know what they're doing. And I also believe in their long-term strategy associated with the transition. And so they have a lot of different pokers in the fire with respect to solar, wind, and many other opportunities out there as well. And so have about an 800 some position there, and I hope to eventually get that closer to 1,000. Getting a screenshot. Oh, I thought you meant screenshot and you're dipping. And then I also talk good amount about Google, Amazon. Those are ones that I truly love. Those are hoping positions that I can get closer to 400 shares by the end of the year. But I'd have to probably sell some stuff in order to do that. So that's really that. And then JEPI is an income fund that mostly focuses on like 30 or 40. Maybe it's closer to 100 actually. Maybe I'm thinking of Devo. Different stocks that are in the S&P 500, but aren't necessarily 100% technology focused. So it's a different way. So it's kind of like a QYLD or an RYLD or an XYLD, but a little bit less focused specifically on getting entirely income. So they're a little bit more laxed. Granted, this was only like a 5-6% yielder not too long ago, and it seems like they've kind of focused more on the dividend yield rather than focusing on long-term growth, which I didn't really invest in it for long-term growth, but I invested in JEPI more than like an XYLD or something like that, because I was hoping it'd be more balanced. And it's the same reason why I invest in XYLG as opposed to XYLD, because it focuses a little bit more on balance of a little bit of income, but focus on, investing in the S&P and then only writing covered calls on 50% of the opportunities. And so I might relook at investing whatever here is in JEPI into XYLG. So that's something I might consider. And following on with that with Devo is like 30 to 35 individual positions. That's done relatively well. And this is another one where I might potentially look at putting it into XYLG and then just kind of combining everything. And that'll take a huge hit to the dividend income overall for the portfolio, because I think it will be closer to a 4.5-ish% dividend yield comparatively to, say, the almost 9% that you're seeing from JEPI at the moment. But, the portfolio, as I get older, and as you can kind of already see here, decent amount of dividend income. If I need to switch these to strictly dividends to pay for bills or something like that, I have that opportunity. But for now, to me, it's more about long-term focus on capital appreciation. So I can use that to either create a business in the long term, real estate, what have you, provide that optionality. If I need to get the dividend income, I can get the dividend income by moving things into higher yielding positions. Um, and then following that up with Pepsi. Pepsi's one that I'll probably continue to shrink. It's not that I dislike Pepsi. I just don't, with where it's at now, it's richly valued. But it always is going to be paid for a premium because it is such a good product, specifically with their snacks line as well as their beverage line. So you like Doritos, you like Lay's potato chips, or you like Frito Lay, you're unknowingly buying Pepsi products. So I think that they do a good Gatorade as well. So you like all those opportunities and brands, then Pepsi's your kind of guy. But because of what has been going on, Pepsi's had a pretty good price premium associated with it because they've done really well in their pricing power post pandemic and even during the pandemic. A lot of people were buying their products for snacks and stuff during the pandemic, and they've continued to grow revenue, 7 to 8% year over year. And so if you couple that with a good 25, 30x sort of price multiple, of course, you're going to get a pretty good price on the company. So to me, it's, buy low, sell high, right? And as much as it would suck to get rid of Pepsi, I think it has a good runway in the long term. I just don't see it really overperforming the S&P 500. And so if I have the ability to eliminate that single stock risk and either put some of that into SPY or calculate it into something that has a little bit more medium term risk, but has much higher potential to double or triple or quadruple or quintuple, then I'd rather take half of the money in Pepsi, put it in the SPY, and then find a focused company that I can kind of look through some of the risks and mitigations. And actually, this holding here is a little bit wrong. It says I have 214 shares. I only have 200, and a part of that money that I had actually went into Dutch Bros. And I did the same with Johnson and Johnson, which I think was the 11th position in the portfolio. It's about comparable with Pepsi. So I sold both of those. I've been reinvesting all my dividends into Pepsi and J&J and not really taking them in cash. And with that, I was able to establish a, I don't know, $4,500, $5,000 position in Dutch Bros. And that's the sort of talk that I want to bring to light, which is Pepsi's a great opportunity. I think it's a great place to store capital if you need it, and it pays a decent yield, close to 3%. But, is an opportunity like a Dutch Bros, looking, maybe not necessarily right now, but looking in a quarter or two, once they get EBITDA cash flow kind of break even, where, right now they're focusing very heavily on store openings. But with every store, they get more revenue, and with more revenue, they get more EBITDA. So they're getting closer and closer by the day to being kind of cash flow break even from an EBITDA perspective. And so it's something to look at. And to me, once that kind of happens, and once their roastery opens in Dallas, it's like, okay, now it's nut up or shut up time, right? Like the risk has kind of been eliminated. They're not continuing to just spin their wheels, right? They're cash flow break even now. So they don't have to go to the market at say 10, 15% to be able to fund their future growth, right? So, and they're pretty well capitalized. I think they have like 500, 600 million in revolving credit or in cash before they really need to go into kind of like further debt seeking mode. But to me, any company with kind of cash flow break even is something I look forward to. So I wanted to share that with you guys because I think a lot of people kind of get a very weird taste about what I'm investing in. It just goes to show you a lot of these things are hangovers from what I was investing in prior to the pandemic, and some of it is kind of hangovers to the portfolio literally tripling since that point, or if not more. I went into the pandemic 2019, 2020 with like less than 500,000, and coming out of that with continued contributions to the portfolio, living overseas and living on, basically the company's dollar, being able to invest a lot of that money instead of like blowing it on trips or drinks or bars and stuff like that. I invested a lot of that money. And coupling with the rebound that we had in 2020 and 2021, and then the slight retracement in 2022 with the kind of resurgence we've had in 2023, the portfolio is very healthy. And one thing that I haven't really been able to do is entirely rebalance the portfolio per se. And so it's been a while since I've shared the portfolio, and it's been a while since I've kind of shared big numbers. So that's just the top 10 positions. And I think that that accounts for close between like 50 to 75%. I'm not 100% sure. And it also depends on if you include certain other company benefits that I get, if you include real estate holdings, you include stuff like that. So it gets complex once you have a little bit of other stuff. But in terms of strictly like stock holdings, it's probably close to 50 to no, sorry. It's probably closer to 60 to 65% of the portfolio is in those positions. If you start including other things, it's probably closer to 50%. So with that, I'll open it to a few questions, and I already see a few. And I don't intend to take too long, as you've already heard. We've kind of been going on for 37 odd minutes talking straight. And so um, with that, I'll probably scroll up to the top and hopefully click through some of these that I see here.